$200,000 worth of ASC income at his tax bracket. If we're offsetting all of it, that's $74,000 in tax savings on a yearly basis. We're not even talking about reps or the short-term rental loophole yet. That's in addition to his strategy. So that kind of tangent there, the point is, we can talk about reps, we talk about the short-term rental loophole, but you might have other opportunities on the table just based on your current income makeup. So I would encourage people to look into that and be very comfortable with that before moving on.
Welcome to the Doctors Investor Club podcast, where physicians and dentists come together to elevate their mindset, build their assets, and create a lasting legacy. I'm your host, Dr. Kyle Stevenson. After years in the OR, I've realized wealth is not just about high income. It's about ownership, freedom, and using your money with purpose. Here at the Doctors Investor Club, we share the strategies the wealthy already know: owning a business, real estate investing, becoming your own banker, and intentional investing. Each week, we sit down with entrepreneurs, investors, and physicians who've stepped off the hamster wheel and are building wealth that outlives them. Because at the end of the day, it's not about how much you make, it's about how much you keep and the impact you leave behind. Let's get into today's episode. All right, hello and welcome back to the Doctors Investor Club podcast, the place where physicians and dentists learn how to think like the wealthy, invest like insiders, and create legacies that last. Today's guest is Gabriel Virdaru, founder of Fortuna CPA, a firm that helps real estate investors and high-income professionals reduce taxes and build long-term wealth. He's advised over 300 investors with a focus on real estate strategy, asset protection, and proactive tax planning, all delivered with the clarity and precision doctors appreciate. Outside of finance, Gabriel has a unique background, including time as a professional soccer player. He now brings that same discipline and strategic mindset to helping clients move faster, smarter, and more confidently. Gabriel, welcome to the show, sir.
Thank you very much for having me. Excited to be here.
Absolutely. Yep. This will be good. Like I said, I mean, maybe I've told you before, but we've had a couple of CPAs on, but I like this, that we're going to focus mostly on real estate. But, you know, we spoke a couple of months ago now, and I was impressed with you, just what you've been able to do. So I would love to tell our listeners a little bit more about you and your background.
Yeah, absolutely. You already gave me a great introduction there, but to build on it a little bit as far as my background goes, always been a numbers guy growing up, even early on through school. Always had a deep interest in business. My father had a trucking business growing up, so I was kind of, typical East European immigrant household. I was involved in that business fairly early on. My life took me down a non-conventional path, as you mentioned. I was fortunate to have the opportunity to play soccer professionally for a few years. Didn't necessarily go the way I wanted it to go in the long term, but great experience nonetheless. Headed back to school and didn't really know what I wanted to do at that point. I actually thought I was going to be a soccer agent. That was my big naive dream at the time. But ended up having an introductory accounting class at Loyola. Fell in love with as much as one can fall in love with accounting and tax planning. And around the same time, got really interested in real estate. That whole bigger pockets rabbit hole, went deep down that rabbit hole, paired accounting and specifically tax with real estate, and developed that interest really early on. But from there, my fiance at the time and I did a house hack as far as our first investment, and went even deeper into the tax aspects of that, and really saw how powerful real estate is from, both as an investment and from a tax strategy perspective. So really just built from there. And the last thing I'll say, my career took me in a fortunate direction in that I was able to work at Hall CPA, which is one of the bigger, real estate strategy CPA firms in the space, and met a lot of great people there, worked with a lot of extremely smart people, a lot of great clients, developed a good skill set, and kind of went off and did my own thing afterwards. That's pretty much it in a nutshell.
Yeah, that's great. Good for you. Yeah, Hall CPA does a good job. They have podcasts and stuff like that, and they get themselves out there. We had Ryan Carrier on the show probably a year and a half ago now, and I think he's since moved on and done his own thing, right?
Yep, Ryan's doing his own thing.
Yep. No, good for you, man. I've never been interested in taxes until probably the last 5 years. I've realized we got a tax problem. And so, I've been diving deep. I got some tax books up here. Amanda Hahn and her husband, they have the whole Bigger Pockets thing you mentioned. They have a couple of books on it. And so, yeah, it's neat. I mean, taxes are our biggest expense, especially people listening, doctors, dentists, high income professionals. Taxes are a big part of it. And so that's probably the number one question I get from other physicians is, hey, how do I minimize my taxes? And everybody thinks it's easy. Sounds easy on social media and Instagram, right? But it's definitely not. And so that's what we want to get into is, what are the ways doctors can really utilize the tax code, tax strategies to offset their W-2 or 1099. So for you, I think real estate's one of the best plays, right? Like there's,
Sure.
gold and oil and all these other things. But what drove you to think real estate and to enjoy that aspect of it? Was it because you got into it, did the house hack or what?
Yeah, personally, it was definitely the house hack and just my personal interest in real estate investing. And then when you tack on the fact that I was a CPA at the time, and seeing how powerful real estate is from a tax strategy perspective as well, I thought those two things paired extremely well. And then, like you said, for high income earners, doctors, dentists, or anyone else in that position, taxes are their biggest expense, and real estate is one of the unique ways where you could strategically mitigate that tax liability, keep more money in your pocket, make your money work for you, and build more wealth. So, really is a phenomenal, space to be in for multiple reasons.
Yep, absolutely. All right, so again, social media is out there, and there's a lot of hype and clickbait and stuff like that. So let's just get started with some myths or big mistakes that you see physicians, high income professionals make when it comes to taxes, basically.
Absolutely. I think two main things I'll mention here is not letting the tax tail wag the dog. It's become a fairly common saying at this point. We'll get deeper into what that means. But more specifically, it's letting these strategies that you mentioned that you do see on social media, making decisions just based on these one-off strategies that we saw, right? So what I always like to tell current and prospective clients is that you need to have a very clear understanding of your personal income and investment situation. That's the starting point to any type of planning that you do, right? What are sources of income? How are they taxed? How are they classified from a tax perspective? Separately from that, what are your goals? Where are you trying to get, right? A lot of physicians that I work in, time freedom is a big thing, right? And they see real estate as a path towards that. That's great. How do we tie the two together? It's not that we saw a TikTok clip on real estate professional status. My spouse is going to go out, buy a single family home and claim reps, and that's the strategy. No, there's a lot more to it. So biggest mistake I see is letting the tax tail wag the dog and not being strategic in terms of tying the investment side of things with the tax strategy, the tax planning side of things. Those two things need to be congruent.
Yep, very good. Yeah, and I'm an example, I would say. In my first property, I did the Burr method, followed Bigger Pockets and all that, and I literally just sold it. I mean, I bought that in 2022, sold it recently, last couple of months. But in saying that, I was like, oh, we'll get into this and we'll start doing these things for tax purposes. And then you realize how much work actually goes into real estate. It's a lot. I mean, it becomes a full-time job to a degree, right? If you're a landlord. And so, the big things that we should talk about is the short-term rental tax loophole, which is not really a loophole, right?
Yep.
And then the other thing is the rep status that you just mentioned. My wife is rep status, stay-at-home mom. But again, I mean, it's taken years of building a portfolio and a lot of headaches along the way that it's like a few years into it. Now we start to see the tax benefits, but it's a lot of work and it becomes a second job. There's no question.
Absolutely. To build up to that point, it is definitely a second job. You're familiar, and a lot of listeners might be familiar with the 750-hour threshold. They may think, I work 2,000 hours, or I used to work 2,000 hours in my job, right? So it's less than half that. But when you take into account the fact that as a real estate investor, especially if you're self-managing your properties, you're essentially on the clock 24/7. Just mentally, it's a lot more intensive than 750 hours may make it sound. But nonetheless, it really is a phenomenal strategy if you are able to get to that point of scale. And like you said, when we can get into it, right, there is a difference between real estate professional status, the short-term rental strategy, and it depends client by client, situation by situation, which one makes sense or doesn't make sense.
Let's just get into it because I think those are the two big things that people can offset their active income, their W-2 or 1099. And then I also want to get into, what does it look like just to be a limited partner on deals, real estate syndications? Because I talk about the lazy 1031 exchange, but I want to make sure CPA is giving us better advice. All right, so get into the short-term rental tax loophole and rep status, and just kind of give us the difference between the two. Which one's the low-hanging fruit, and which one makes sense for people listening.
Absolutely. Well, we'll do a deep rundown here, and I'll even tack one other topic on top of that, right? So please. It goes back to what I said earlier. Down to the individual level, before you get into any of this, you need to have an understanding of your classification, your income classification, right? You brought up the idea of LP syndication investments. Well, what's unique to the doctor and physician world is I've run across clients in the past that have had significant sources of passive income without even being cognizant of it. So specifically, I'm alluding to ASC investments, surgery center investments, right? Those are passive. Whereas W-2 income, or if you're a self-employed position, that's non-passive. Portfolio income, actually interest, dividend, sale of stock, is actually also non-passive, as counterintuitive as it seems. Now, the limitation, and I'll speed through this because I think a lot of people have heard it before. The limitation is that passive losses can only offset passive income. Passive losses traditionally cannot offset non-passive income, right? The not the two main ones, but two of the main workarounds are real estate professional status and the short-term rental strategy, right? If we meet the criteria for one of those two strategies, we could reclassify specific rental real estate losses and use them against active income.
Yeah, so all well and good. It cut out for just a second. So the real estate professional status and then the short-term rental tax loophole is what you said, right? Yep.
They're two of the main mechanisms for recharacterizing what would traditionally be passive rental real estate losses to the non-passive bucket, and we can use them against W-2 income or 1099 income. But even before we get to that point, right, if you're someone who does have a significant source of passive income, like an ASC investment, you're someone who could potentially significantly benefit from an LP syndication investment. You don't have to jump through the hoops and do all that work that we were talking about before to meet real estate professional status, and you can save a bunch of money in taxes. I had, I'll just throw out a quick example. I know I'm getting off on a tangent here, but I think
this is really good actually, because this is a very highly asked question.
Perfect. And outside the umbrella of your typical reps STR discussion, but the specific client that comes to mind, he had an ASC investment for upwards of I think 7 to 8 years now, spitting out $150,000 to $200,000 worth of income every year. And he did catch the real estate bug. He did catch the investing bug. He just wasn't strategic with his planning, right? So someone, I believe a financial advisor, had set him up with a self-directed IRA, and he was investing in syndications through the IRA, which is fine in certain situations, right? But the issue was that the losses were segregated. The K1 losses from the syndications were segregated to the IRA, where it was very low-hanging fruit for him in terms of this large passive income bucket that he had. He could have been using those syndication losses to offset that ASC income. So that was the first thing we discussed. Going forward, make some of these syndication investments in your personal name, have them flow through to the personal return, and $200,000 worth of ASC income at his tax bracket. If we're offsetting all of it, that's $74,000 in tax savings on a yearly basis. We're not even talking about reps or the short-term rental loophole yet. That's in addition to his strategy. So that kind of tangent there. The point is, we can talk about reps, we can talk about the short-term rental loophole, but you might have other opportunities on the table just based on your current income makeup. So I would encourage people to look into that and be very comfortable with that before moving on.
Real quick on that. I mean, the reps and short-term rental, it's active stuff. Like it's a second job. There's no question, right? I mean, to get your wife to do it, and like I said, I'm doing it, and it's a lot of work to document and make sure she's getting the 14, 15 hours a week. Even with the short-term rental, like you can't just put a property manager in there and think that you're going to get the hours, because you have to have 100 and more than everybody else, or 500. And it's a lot of work. So to your point, most doctors, especially surgeons nowadays, or GI, or anybody that's doing procedures, most now do have a surgery center that they invest in. So with that, they get a K1 typically. Like I'm at a place now where I don't get a surgery center investment, but they get a K1, and that's passive income. And then they can use the LP syndications to offset that passive income, correct?
Correct. Passive against passive. Big
Yep.
opportunity. And even on top of that, there's a whole discussion to be had about the specific types of syndication investments, right? If we really want to get deep into the weeds in terms of how bonus depreciation works with the passing of the big beautiful bill, 100% bonus being reinstated, but even in terms of specific asset classes, right? Regular residential real estate, typically 20 to 30% of the purchase price or the building basis is reallocated to bonus eligible property. But there's other types of asset classes, specifically mobile home parks is a big one that comes to mind, car washes, gas stations. Those pass through a lot higher first year bonus depreciation. So if you are one of those doctors in the position of having that ASC income, there's a lot of planning just to do around that, right? Which again, we're still in the passive bucket. We're not even talking about all the works that's associated with reps in the short-term rental. So completely agree there.
I love it. I mean, I'm glad that we're starting with this just because, again, the reps and short-term rental get all the attention, but because of the work it goes into it, I mean, as a busy doctor, it's just so hard to try to establish that. Like, you're basically starting yourself a second career to get into real estate. And there's a lot of, bumps along the way and learning curve. And so this is actually very important to talk about because it's, to your point, it's like a low-hanging fruit that, docs don't know about. And then the other thing I'll say is, you've mentioned this a couple of times, but it's like, understand your situation, understand the systems that have to go in place to take care of what you need, your needs. And I liken it to a family office only because, I've partnered with the Family Office Club, and a lot of family offices, they have their financial advisor, they have their CPA, they have their strategist, they have all these people that work together for them, and they're not in silos. And I think too many doctors have silos, right? They have their financial advisor over here, they have their CPA over here. They're not necessarily communicating. And so that's one thing that I've stepped up on these last few years is I'm getting these guys in the same room and we're talking it out. Like, hey, how much cash do I have for this? Will this help me on taxes? And bringing them together. So I think that ecosystem is important.
100%. Everyone has to be rowing the boat in the same direction or else we're going to run into issues, right? I've personally run into that, especially you mentioned financial advisors. If they're not on board, right? If they're not understanding of the strategies that their client is pursuing, that is going to lead to friction and leads to headaches. So 100%, but having the team in place with a common goal is extremely important, especially if you're going to go down the path of exploring real estate or other alternative investments that your run-of-the-mill financial advisor probably usually isn't exposed to or comfortable with. So super important.
Yep, very good. What other stuff do you think you want to talk about with reps or short-term rental tax loophole? Because I definitely want to cover it, but I think, trying to figure out even other strategies or something that we don't even know about would be awesome to talk about too. So from your experience, when the audience is doctors and dentists mostly, when they come to you, what are you mostly talking to them about?
Yeah, so we still drill deep down into reps and the short-term rental strategy as potential opportunities, right? And it goes back to what I said. We're starting off with what's your income classification and what are the opportunities. Reps and short-term the rental strategy are two opportunities we'll explore. For reps, your spouse needs to be on board. I have run into situations before where the doctor, the client I'm talking to, really wants their spouse to pursue real estate professional status, but then when the spouse actually joins the call or strategy session, they're not really all in. And it's not doable, right? Like you said, it is essentially a full-time job, so they need to be 100% on board. Even if we get to that point, it's creating the rep strategy, right? Like if we're starting off from zero, I have clients that come with no rental property investments or maybe one or two. How are we going to build that reps base that allows the spouse that's targeting reps to meet thresholds, right? And there's different ways to do that, right? Probably two main to cover on our discussion here today. You alluded to the burst strategy. That's a great strategy for building up hours on the rep side, right? Maybe buying a property that's not too expensive, comparatively speaking, to allow that spouse to get the hours. And tying the strategy together with syndication investments that we group in, right? There is a provision within Section 469 that allows us to group in all long-term rental investments together. That could be a phenomenal way to get to reps. So for reps, I'd say it's being strategic about how we're going to get there and creating that 1 to potentially 5 year plan, that scaling strategy, and modeling it out. That's extremely important on the rep side. And 469-9 grouping election, I'll mention that again, extremely important. Actually, I reviewed a return this morning for a dentist client whose preparer missed that election, and he had $66,000 of syndication losses suspended in the passive bucket that should have been non-passive. So grouping election, extremely important on the rep side. On the short-term rental strategy, what I've found myself saying is, had we had been having this conversation early onset COVID, it would be a different discussion, right? You could have bought a short-term rental essentially anywhere in the country, throwing it on Airbnb, and that thing was going to cash flow based on purchase prices and interest rates back then. What I'd caution clients again, I don't want to say caution, but what I want to make sure they're comfortable with if they're going down the STR path, you're getting into a different business. You're getting into the hospitality business, and you need to be comfortable with that, right? It's extremely attractive from a tax perspective because the material participation hours threshold is lower. We're essentially targeting 100 hours and more than anyone else versus 750, and both spouses can combine their time for the purposes of the 100 hours material participation. Super doable. But you need to be diligent with your underwriting. You need to be diligent with your research. You need to be comfortable with the fact that you're getting to the hospitality space, either indefinitely, if you're going to keep self-managing it, or if we're just doing it to get the strategy in the first year, to get the tax benefit in the first year. That property in your underwriting, you need to factor in help. So that's going to be property management, the use of a virtual assistant in year 2. Make sure that still makes sense from an investment perspective. So those are 2 big items that often come up when it comes to reps and the short-term rental strategy. I always encourage people to think about both of them.
Yeah, that's good advice. And to your point, I mean, in 2020, 2021, like short-term rentals were popping off. And now it's definitely, you got to do your underwriting, due diligence conservatively to make those numbers work. Because, with interest rates being high, with Airbnb just not being as fruitful, I think as it was. And then a lot of cities are also pulling back on it. Putting regulations in place. And so you don't want to get stuck to where it was a short-term rental. They changed the rules, and now you got to make it a long-term, and it doesn't make sense financially.
100%. And I think I saw something recently that it's the days of, there used to be a common notion that target a short-term rental that could work as a long-term rental as well, right, as a backup plan. From my experience, I don't think that's applicable anymore. If you're going down the short-term rental path and you want a well-performing property, you kind of need to be all in on that. Like amenities are a big thing, adding that to properties and making them an experience of sorts. That's just to add on to the fact that it is a different world in the short-term rental game than 3-4 years ago.
Yep. Great. And I can tell you my personal experience, my short-term rental that we have. So our portfolio is bigger because we're doing GP deals now. So my wife's getting a lot more hours with that stuff, but we still own a triplex and we still own Airbnb downtown Indianapolis, but we're trying to just we're tired of dealing with the headaches of it. And it's not terrible by any means, but here and there, your cleaner does this or, something happens. And so we ended up just hiring a property management group that they're going to come in and keep it in Airbnb. They're going to boost the numbers for us. So our cash flow will be better, but we're not going to get the hours that we would if we were just doing the Airbnb. And so for us, it makes sense to do that. But I would say for most, it probably doesn't to have a property manager unless you have enough properties that you can still get the hours. Because at that point, you just want to get 500 hours, right? Because it's going to be hard to get more than the property manager.
100%. Yeah. And timing matters, right? The strategy there could be get your hours in year 1. And then if it's a one and done thing and you just want to hang on to that property, then utilizing property management in year 2, not the biggest deal in the world because we squeeze out the juice, if you will, in year 1 by applying the cost tag. But you're right. If let's say you're going, because I always encourage clients to think down the line, right? You get down the short-term rental path. Do you want to scale it? Do you want to buy additional properties? Then in an ideal world, you would get to that 500-hour threshold because that allows you to group those short-term rental properties together. And it really opens up doors in terms of utilizing property management on additional acquisitions. But important to think about, and you kind of don't know until you get into the space. That's what I tell people. Like, got to get your experience and see if you like it or not.
It's true. A couple of points I'll make real quick. 2 things. The first thing I'll say is don't don't let the tax tail wag the dog. That was the quote you made earlier, which,
Yep.
you hear a lot, but it makes total sense. It's absolutely true. But the other thing is, don't get into real estate if it's a short-term play. I mean, for the most part, like this should be a long-term play, in your mind at least. Like, know that you're holding on to this property for 10 years, 15 years, 20 years, maybe, like don't think I'm going to buy something in November, get the, do the cost segregation, get the bonus depreciation, and then sell it in the next year, because it's probably not going to be the case and you're probably not going to make money. Like real estate's a slow build wealth slowly over time, right?
100%. Yeah, I'd say it's especially for physicians, doctors, it's like a wealth compounding strategy. It's not something that's going to make you rich overnight. And even from the tax strategy side of things, depreciation recapture is kind of something you were indirectly referencing when you brought up the 1031 light, right? That's if we're buying properties and selling them the next year, within 2 years, what are we really accomplishing at the end of the day? We're going to be paying back the tax benefit, and we're not really building wealth. We're not benefiting from cash flow appreciation or loan pay down, principal pay down. So, ideally that should be the goal when people go into these investments.
Yep. And one other point I'll make, and a question I have is, if you're going to do a short-term rental, is it ideal? I've heard this strategy and I kind of like it. Buy something that needs a little bit of fixing up. Maybe it's burr, or just, you got to renovate a little bit or add some furniture. Buy it in, late summer, early fall. Spend a few months renovating, and then start putting people in November, December, so you get the benefit of that year, and you really only had a couple people in there, so you'll get more than everybody else. And that's the substantially more than everybody else rule, which is not the 100 hours and it's not the 500 hours. It's the substantially more than everybody else.
Yeah. So the one you're referencing is substantially all, which is essentially you're doing everything, and that could be applicable. But even taking a step back from that, that's a phenomenal strategy that I often bring up to clients. If you get timed acquisition in the second half of the year, not too late, right? I've run into situations where people close on December 20th, a few days before Christmas, and then it's a mad scramble. Ideally, we're not leaving it that late, but yeah, late summer, early fall is a great time short-term rental acquisition from a tax perspective. It doesn't necessarily need to be a fixer-upper. It can be if it makes investment sense, but any short-term rental, unless it's turnkey and it's coming furnished, right? That's not quite that common. Any short-term rental is going to necessitate a setup, right? So if we're acquiring it late in the year, both spouses, assuming it's a married couple, are willing to go out to the property. I'm just making the assumption that it's out of state or not local, right? They're willing to go to the property, get it ready, get it furnished, put in the work to, over a weekend or two. That's a big chunk of the 100 hours that we need. To your point, right? If it's a local property where, let's say, you do the setup yourself, there's no deep renovation work where you need like a contractor to assist you. You do absolutely everything yourself. You get a couple of stays, and let's say you do the turns yourself as well. We could potentially qualify under the substantially all material participation test and not have to worry about hitting 100 hours. But just speaking from experience, people usually breeze past that 100 hours, assuming we're acquiring it sometime in late Q3, early Q4, just with the amount of work that's required.
Do you have to rent it out that year?
Yes, you do. Okay. Because going back to what the short-term rental strategy, loophole, whatever you want to call it, what it actually is, test one is the average stay per guest needs to be under 7 days. In order to establish an average, we need at least the conventional wisdom here says at least 2 stays to establish that average.
Mm-hmm. Yep. Good point. Great point. All right. I like those, and people can continue learning more about both of those strategies because they're fantastic. But again, it's work. And, so just know that you should definitely underwrite, the bigger pockets. What resource do you give to people, or who do you connect them with on underwriting, or how do you do that?
Great question. So I'm going to give a shout out to a company here, strsearch.com. is a resource that I've been pointing clients towards. So the people that run that specialize in the STR space, I believe they're connected with TechFester, which is one of the largest short-term rental fund in the country. So reason I like it is that they have a few different resources there. They have free resources. They have a course that I encourage clients to look at when they're considering a short-term rental. And they have a property match service as well. And their track record, from my experience, has been phenomenal in terms of matching people with cash flow on short-term rentals, which is getting harder and harder to do, like we've discussed. That's one resource I'll point people towards as a starting point, regardless if you want to pay for the help, or regardless if you just want a free education resources to get going. And that will walk you through analyzing markets using AirDNA, right? If you've heard of AirDNA, to forecast revenue potential, competition, what type of property you're looking for, what kind of amenities that you need. That's a great resource I was pointing clients towards.
Yeah, that's good. It's very good. Yeah, and I'm not trying to scare anybody away from it. I think they're both phenomenal strategies, and I've used them both, and I'm using reps now. And it's all about, what makes sense for your portfolio and your time and your, situation. And if you want to do Airbnb, then hop in with both feet, really understand what you're doing. And it actually is kind of fun, honestly. I mean, there's a dopamine hit when people, book.
Yeah.
And so it's a lot of fun for sure, but you just got to know what you're doing. Look at the resources, dive deep into it.
100%. You got to go in prepared. And it is still a phenomenal strategy. It's just a matter of, being comfortable with what needs to be done.
Yep. All right. So on the flip side of that, let's go to limited partner syndications. I like real estate syndications. I've been doing them for 6 years as a passive investor. Now I'm doing more general partner stuff, which I enjoy. And I talk to doctors and dentists about this stuff all the time. And the big things for me that I harp on is find the operator that's well trusted, who's been through it, who's exited deals, who's been full cycle on deals, gone through these last 4 or 5 years, which have been tough on the market cycle. But it's a great play for busy professionals. And so you mentioned it. We can do the cost segregation, same as, with anything else. You can do it with, as an LP investor, get 100% bonus depreciation, but it's all going to be passive. And so with a surgery center, that's a great play. But otherwise, go through the tax strategy with us. I talk about you said 1031 light. I call it the lazy 1031 exchange. Yep. And the way I understand it is, like, when we exit a deal, I get my original capital back tax-free. And this is to say that we're selling the property. Say we sell it in 5 years. Mm-hmm. Original capital, say I put $100,000 in, $100,000 comes back tax-free. Then we made, 2 extra money. So that other 100,000 would be long-term capital gains. But if within that same year, I could invest that profit into another deal, some of that, if not all, could potentially be offset with the depreciation of the new deal, correct?
100%. Yeah, it goes back to the treatment of passive income and passive losses, right? So that LP syndication investment, as we've discussed, is passive. When that exit event does occur, you're right. The gain that gets passed through to the LP investor is passive. It's not going to be quite a tax-free 100%. On your $100,000 example, it's not quite all tax-free because the depreciation that was passed through to them in year one reduces their basis, but the core concept is valid. You're right. But whatever gain is passed through to them, it's going to be capital, and there's also going to be depreciation and capture in there. All of those, though, could be offset by new passive losses. So the lazy man 1031, the 1031 light, whatever you want to call it, different terms for the same concept. The idea is that in the same tax year, that's key, right? So this is where planning comes in, and you being up to date on the plans of the operator, the GP team, like when the exit is going to occur, working with your advisor to figure out what your portion of the gain is going to be, and planning a new investment in the tax year, in the same tax year, that's going to pass through a passive loss that we can use against the passive gain. And that's, again, where, depending on the specific individual's situation, we get a lot deeper into what type of investment makes the most sense from a tax strategy perspective. Mm-hmm. Do we need a lot of depreciation? Then maybe we could look at some of those mobile home park syndications as an example. But yeah, it's a phenomenal strategy. Even if you're not in a position where you have passive income to offset, right? It's still tax shielded and potentially tax deferred income if you structure it correctly.
Yep. And you talk about mobile home parks and car washes, things like that. Those just have when you do a cost segregation, they just give you a higher bonus depreciation than if you compared it to what, self-storage or compared to multifamily?
Residential, commercial, residential, multifamily, commercial, self-storage. For the most part, they're all going to be in that 20 to 30% reclassification percentage. So to kind of expand on that, let's say it's $1 million purchase, and let's just pretend the full million is the building basis. $200,000 to $300,000 is going to be accelerated in the form of first year bonus depreciation, right? And let's just pretend we can pretend it's 10 million or 100 million, and this is a syndication, right? You as an investor, as an LP, are going to have a piece of that coming through on the K1 that you receive from the partnership. It's not that you have to do a separate cost save, right? That's done at the partnership level, at the property level. That flows through to you, and you could use it or not use it depending on your specific situation. Versus the mobile home park, the car wash, and the gas stations. The reason I bring them up, instead of 20 to 30%, it could be, depending on the investment and the asset class, upwards of 50 all the way up to close to 100% in terms of the gas station. So if you're someone that needs a lot of paper losses in a given year, those could be a phenomenal investment for you from a tax perspective.
I like that. And then let's just talk about the 1031 exchange real quick. Because I've had buddies ask me about it for like being an LP in a deal. The way I understand it is you essentially have to determine that before you invest in a deal, because the entire LLC would have to do the 1031 exchange, not just one individual from that LLC. Is that correct?
Correct. The whole partnership needs to be 1031ing. You can't just 1031 your own portion. It could be structured as a TIC, as a tenancy in common, where each, that's not as common, and we're usually talking about large scale dollar amounts in those situations. But you're correct. You can't just 1031 your own portion traditionally. It needs to be a partnership as a whole.
Okay. Yep. And then, give us an example of, say, it doesn't even have to be a doctor or a dentist, but somebody's making good money and they come to you and, they've been working with their CPA who's just been doing their taxes every year, but they haven't strategized. What's the common thing that you see people come to you and they're missing out on?
Yeah, it's going to be kind of a simple answer, but it's the lack of any strategy whatsoever. It's, traditionally your CPA, you go to file the tax return, and planning is telling you how much you owe in the form of an estimated payment or doing a projection for you, right? So what's missing is doing that deep dive into the income sources and the investments that you have, how much liquid you have to invest, how much maybe you have in a brokerage account that you're willing to take out and put into real estate, is doing a deep dive analysis of that, and then running through all the opportunities that are on the table, going through in depth what that would require, right? And we've been alluding to all the work that goes into reps, the short-term rental strategy, going through what would need to be done in order to meet the criteria for the strategies, what the light at the end of the tunnel is, what the risks are. So that education piece is about as simple as I can put it. That's the big thing that's missing. It's the lack of education, lack of understanding in terms of what the options even are before going down a specific path. So clarity is the big thing.
So, I've totally forgot to ask about cash out refinance, and I want to ask about that, but let me finish on what we just talked about. Are people coming to you, they have their CPA and they're coming to you as a tax strategist, or are they just completely moving everything to you for everything, all encompassing?
Great question. Both cases. It's a typical scenario where someone wants to keep it prepared for whatever reason and just utilize us as an advisor. The commonality for us is that any new client that we take on comes through an advisory engagement. I always tell clients that in an ideal world, your advisor and your tax preparation are housed under the same umbrella, just so it's seamless. But as long as, maybe you have someone who's a phenomenal tax preparer. A lot of CPAs are great tax preparers, right? It's in terms of preparing the return, and if they're comfortable implementing the strategy that you put in place, that could work. But all the work that you do and all the hoops that you jump through, if it doesn't get reported properly on the tax return at the end of the day, it's completely irrelevant to everything you did. So could go either way, but my recommendation for people is always to find an advisor that could also assist them with their tax preparation.
Mm-hmm. And then, so jumping back to LP syndications on real estate, whatever asset class it is, but if, say, you have a 5-year plan and in 5 years, it makes more sense. Let's do a cash out refinance the property, and then we stay in the property. All that money is tax free. Am I correct? Or tax deferred? The cash out refinance is tax deferred, correct?
Correct. It's not a taxable event. Refi is not a taxable event in most cases. It's just increasing your debt basis in the investment in the property. So could be a great way in certain situations to get liquidity without creating a tax event.
Yep. And I would even say, with residential right now. So say you have an Airbnb, which again, we have a triplex and an Airbnb. We bought them in 2023 and maybe 24. Like, rates are obviously high. The numbers make sense for us, but when I can refinance, hopefully in the next year, then that could be a really cool event for a cash out refi on both of those properties. So even for residential, that makes a lot of sense.
Absolutely. Yeah, it's tax-free capital they could tap into or reinvest into other sources and kind of continue compounding that wealth, continue building that asset base. But yeah, it all goes down to, where's the market at, where are interest rates at, and does it make sense for that particular investment? How much longer you plan to keep it? Can you stomach the higher payment? All things to consider. But yeah, it could be a great strategy for sure.
Mm-hmm. Yep. So, in general, like when you have these conversations with clients, what do you guys discuss when it comes to their relationship with money and taxes? Are most of your clients, they coming in like understanding some of this stuff, or are they just completely green for the most part? Do they have any issues, or is there a lot of resistance to what you're doing? How would you describe that, especially with doctors and dentists? I'm just trying to get a gauge on that.
Great question. I wouldn't say there's resistance. I say there's a lack of education and understanding in most cases. So one thing I always tell clients is tax planning, especially when it comes to real estate related tax planning, it's not a kind of outsource and forget it type of thing. There, you do, as the investor, as the taxpayer, you do have to have a certain level of knowledge so you kind of understand what you're implementing and what you're getting into. So it always starts with education, and it varies. Like I think doctors are unique that they're extremely smart individuals that have dedicated their lives to certain discipline over time, and I think it's difficult for some people to admit that they're novices, like when it comes to the financial world or tax planning, and it shouldn't be anything that you need to be embarrassed about. But it's being willing to put in that work up front to get that baseline understanding and work with someone who is an expert in the space to create a strategy that's tailored to their situation. So where are we at? Where are we trying to get? What's the most efficient way to get there? That's the simplest way to define the type of planning we do.
Yep. Nope, that's great. It's about collaborating, like a lot of doctors do have an ego. It's good when we're in the OR, good when we're taking care of patients. But I think when it comes to taxes and when it comes to finances, some have a hard time letting go or being, not knowing everything, right? And so I think it's important to let the expert like yourself, really dig in and help you out.
100%. And I think that's, there was a thing that you brought up about what's the frustrating part or what's the difficult part about it being an advisor, and it's identifying what type of advice or direction particular individuals react to. So there's certain people who like to feel like they're in control, and you just have to guide them along the way, right, by giving them the information that you need or that they need. And there's other people that just want concrete, actionable advice, like, hey, this is where you're at, this is how you get here, this is what you need to do. And doctors, they're different types of doctors, right? They're different types of personality types, and they fall somewhere on that spectrum. And it's important to identify that early on in terms of a client-advisor relationship. What type of feedback do people react to?
Yep. Nope, that's great. And so, all right, to let you plug yourself and, boast about what you're doing, I've talked to Keystone CPA, which is Amanda Hahn, and I think Matt McFarland, her husband. I've talked to them before. Paul CPA, I've talked to them as well. So a lot of docs are trying to figure out, like, okay, who should I go to? What sets you apart from going to like these, people that are market themselves like crazy all over the place on social media and stuff like that? Like, why would somebody want to come to you as opposed to just going to Hall or Keystone?
Yeah, great question. And I guess to start off, Hall, especially having the experience of working there, right? I'm not going to say anything bad about Hall. I think it's a phenomenal firm. It's a phenomenal place to go. My differentiating factor, I would say that I'm still early on in the journey, and I'm still at a place where I love doing the one-on-one work. I have no plans of outsourcing my advisory work for the time being. I'm purposeful about the new clients that I take on. So one thing I would encourage people to think about is who are they going to be working with one-on-one. With me, you'll have a conversation directly with me. You'll be working with me. You kind of know where you're getting. Versus some of the larger scale providers, sure, everyone's extremely qualified, but you're not going to know if you mesh with that person until you start working with them. So that's what I would encourage people to think about. It's ultimately the advisor is your one-on-one relationship. That's who you're working with. Company is great, but you want to make sure you have a very good relationship with that person that's actually guiding you through these strategies.
Mm-hmm. I agree with that, man. And I could tell you, like, we went through the experience where I was unhappy when I was trying to figure all this stuff out a few years back. And we just we kind of felt like we were like being funneled, that whole like marketing strategy that brings you in. And then you're not even talking to them. You're actually talking to like one of their peons. And then you jump on these like weekly calls or whatever, and you're just a number. And none of it felt personal at all. And I was like, okay, we definitely got funneled here. But I hear that from a lot of people, so there's a lot of, frustration out there. And that's why I think, I wanted to have you on and because I think that you're just, a very personal dude and relatable, which helps a lot. Goes a long way.
Appreciate that. Yeah, 100% agree.
Mm-hmm. So, all right, this is some other stuff that is not really real estate. Well, necessarily it could be, but I just want to get your opinion. And if you don't have an opinion, then, that's fine too. But like a lot of docs I talk to, I'll maybe start this way. I started off my podcast talking about real estate investing, and then it slowly transformed into how do we think like the wealthy overall, not just real estate, but overall. And partnering with the family office club, understanding how the family office, how they do things, trying to understand other tax strategies, and then bringing that together with conversations I've had with doctors who are like, I want an ultimate legacy play. Like I'll just 1030, defer, die. All my real estate's going to go down to the heirs, my kids and then the grandkids. But I think there's other strategies, and one of them is cash value whole life insurance, becoming your own bank. I think that's a good way to have some tax-free growth. Use that money and you can invest it, or you can do things with real estate. What are some other planning strategies that can utilize real estate, but also utilize other maybe tax strategies that you could speak on when it comes to legacy and more long-term stuff?
Yeah, 100%. I definitely think all this stuff is not one size fits all, right? There's different strategies that could be implemented. Like oil and gas is a thing that I think you briefly brought up earlier. There's different things that could fit in the overall pie. But when it comes to legacy planning, that's where I always encourage people to be proactive, right? And being, having a plan in place to pass down your assets, right? Having some type of entity structure is something we haven't brought up, right? So it goes back to having your overall team in place with your tax strategies, your financial advisor. You should have an attorney on your team as well as part of this whole family office package, right? Having that trust in place, being cognizant of the state tax limitations, right? That's been increased with the big beautiful bill. I believe it's 15 million for single and 30 million for married if you're married, right? So you want to have a plan in place for passing down assets. And estate planning is a whole different can of worms, right? Like that's not something that I touch on it, but I don't personally specialize in estate planning. I have resources for my clients who do need to have that conversation. Whole life insurance, cash value. That's another thing I'm not personally an expert in. I'm obviously familiar with it, and I have resources and contacts that assist clients who want to go down that path. I guess I'm not giving you a clear answer, but my answer is at the end of the day, you need to have everyone rowing the boat the same direction, like I said earlier, and that could come in different forms. It's not all or nothing. You don't need to go all in on real estate investing, target reps, do cost eggs and rinse and repeat. You can bring in, the life insurance strategy on this side, or some sort of trust structure once you get to a certain net worth where it makes sense. So
Mhm.
that's the
Yeah,
way
no,
I
that's
think
good.
about it.
No, that's good because you have your niche, right? Like you are real estate tax strategist essentially, right? CPA, and
Yep,
but you have resources to help people if they want to do this or do that. Then you can bring it all together if you need to.
100%.
But when it all comes down, what it all comes down to, I think, is docs and dentists do need to be proactive. It can't just be like, all right, I'm gonna just have my financial advisor and he's gonna take care of everything, because the fact of the matter is, like, they may, but they also may not. I mean, I bet you 90% of financial advisors out there probably don't take care of all this stuff. And so you really don't know what you're getting into unless you are proactive in your own finances, your own tax strategies. And that's why bringing in a guy like you as part of the team would help a ton, right?
100%. The earlier you can do it, the better. It's never too late to get started on planning, but the common theme of what I hear from doctors after kind of working together is I wish I got started on this earlier. So that's my one overarching message to everyone, right? It's never too late to get started. The earlier you do it, the quicker you do it. Now that you're aware of kind of some of these opportunities that are on the table, the better it will be for your ultimate situation down the road.
Hmm. That's great. Yep, we're finishing up here, and just a couple
Mhm.
more like quick questions, and at the very end, I'll end with 4 rapid fire. But for you personally, doing this and branching out on your own, I commend you for doing that. I think it's amazing to take ownership, to feel the impact of what you're doing, and give us some joys of what you're experiencing when you started Fortuna. What's the most fulfilling thing that you deal with? What are some successes? Anything like that.
100%. I guess on a personal level, my goal has always been to run my own business, and that's come in varying forms over time. So I get fulfillment just from going down that path and having that 100% control and being able to make decisions quickly and execute on them quickly. But what still fulfills me in terms of what I do day to day is actually enjoy the taxes and tax planning. And I found that I enjoy working with doctors, and I always get extremely deep satisfaction where the way I have my advisor engagement structured, we do like an intensive first phase that we usually knock out within a month to a month and a half. And I love seeing that light bulb moment on my clients' faces, like at the end of phase one, where wow, we actually, for the first time in our lives, feel like we have a tax strategy that we're comfortable with, that we're confident in, and that we're ready to execute on. So just that's a good dopamine hit for me every single time it happens, and tends to happen time and time again. And on top of that is being there while they're executing, right? Having worked with 300 plus clients to kind of see them go down the path and see the fruits of their labor on the tax planning side, that's always extremely satisfying. So that's what keeps them going every day.
That's great. Yep, I love it. And I'll say, like, people reach out to me all the time about this stuff, and they're like, "Oh, what would you do with this?" Or even some people will be like, "Hey, there's coaches, there's physician coaches out there that coach on real estate investing, coach on certain things, and the tax strategy is the biggest part of real estate investing." And I thought about it for a short time, like, okay, maybe I could set up a course and make some money, some extra money on that stuff. But the fact of the
Mhm.
matter is, like, I'm not a CPA. I'm not a tax strategist. I just trust guys like you who do this stuff for a living. And so I actually get more joy out of having somebody like you on the podcast to talk about this stuff. And let's educate physicians, near and far, to better their own wealth, build that wealth. But I'm not trying to take people's money to advise on things that I'm not an expert in, basically.
Sure.
You know, so that's why I appreciate you coming on to help educate people listening. And yeah, we'll keep it going. Any parting words before we get to that rapid fire?
Uh, no, I think you put it beautifully.
And real quick, usually I do this at the very, very end, but where can people find you if they listen to this and they're like, man, I love what he's doing. I love to meet him. Where can people find you?
Sure. Yeah, the best way to get in touch with me would be to go to our website, fortunacpa.com. Once you get on there, you'll see an intake form to fill out with kind of your background and a link to schedule a call. So if you're interested in learning more and seeing if strategic real estate related tax planning makes sense for you, that's the best way to get in touch.
Good. All right, last 4 questions. What book are you reading right now?
Yeah, I have it over here off on the side. $100 Million Money Models by Alex Hormozy is the one I'm reading now. So it's more, business related, could be real estate related, but phenomenal book. And all 3 of the books Alex Hormozy has published, I highly recommend them to anyone.
Yep, he does a good job. What advice would you give your 25-year-old self?
I would say get uncomfortable faster. So I don't know if it comes across, hopefully not too much. I'm a naturally introverted guy. Takes me getting out of my comfort zone to even do things like this. So my advice to my 25-year-old self post-professional soccer career is get uncomfortable quicker, and you'll only have growth to benefit from that.
That's great. Real quick, I just listened to this podcast with Grant Cardone. The Family Office Club has events, 16 events throughout the year. And he just had Grant Cardone come speak at their big event in Fort Lauderdale. And Grant Cardone actually mentioned that as well. He's like, every time I get uncomfortable, I grow like crazy. And he's still doing that. He's still forcing himself to get uncomfortable. So
100%. That's great advice.
Yep, good for you. What's your definition of wealth?
Yeah, that's changed over time. I think at this point for me, it'd be freedom of time and freedom of choice. So making enough money to live the lifestyle that I want to live, but also have enough control of my time to spend it how I want to spend it with the people I want to spend it doing the things I want to do. That's as simple as I can put it.
Mm-hmm. And then Proverbs 11:25 states, a generous person will prosper. Whoever refreshes others will be refreshed. If you can make one lasting impact by giving back, what would it be?
Yeah, that's a great one. So for me, a big thing now is giving back to the younger generation. So specifically accountants. I have a deep interest in kind of making them aware of different pathways that they could go down. Big Four and big public accounting is pushed extremely heavily in collegiate courses. So I'd like to kind of give back to the younger generation and make them aware of some other pathways they can follow, as well as real estate investors. I'm trying to get convince my cousin, sophomore in college, house hack straight out of college. It's a no-brainer. So those 2 things, passing on information and trying to make people's lives better by setting the path they're going to go down.
Yep, that's great, man. That's good legacy play. Teach the young generation to do a lot more of this stuff, because unfortunately colleges aren't teaching, the right things, I don't think, at this point.
100%. Agree.
Well, good. Gabriel, we appreciate you coming on. We appreciate you making taxes feel less like a burden, more like a strategy. This was a great episode, and I know that people will get a ton of value out of it. So we will, hopefully more people reach out to you based on this, and we will talk soon, man.
Awesome. Thank you so much for having me on. It was awesome.
Absolutely.
This is my time. I'm on the rise. Can't hold me down. I'm too fly. This is my time.
Thanks for listening to the Doctors Investor Club podcast. I hope today's conversation inspired you to think bigger, dream bolder, and take the next step toward financial freedom. If you're a doctor or dentist and you're ready to join our community, head over to doctorsinvestorclub.com. There you'll find our free mobile app and private forum, built exclusively for physicians and dentists, featuring AI tools, curated investor resources, and live event access. And if you're at the stage where you want to see real estate opportunities we personally invest in, you can visit investwithdrkyle.com. There's no pressure, just transparency, education, and access when you're ready. Subscribe to the show, share it with a colleague, and remember, you're not just building wealth, you're building a legacy.
This is my time. Ready to shine.